What's the greatest obstacle or challenge facing you on your path to becoming financially free? For most of us, it's the time it takes to even focus on it. We're so busy with our lives that we don't even know where to start. Come join Joey and I and the team in Nashville, Tennessee, August 9th through the 11th, as we break down the different ways that you can become financially free and introduce you to different strategies and speakers who can help you on that first step.
You have questions? This event is designed to give you the answers, to take action fast, to turn the decades it's taken us to learn this and turn them into days. Don't hesitate. Go to wealthwithoutwallstreet.com/live. And don't forget to use the promo code podcast to get a deep discount.
Wealth Without Wall Street Tribe. So glad to be talking parking lots and parking systems with Brian Spear. Brian, glad to have you.
Oh my gosh, extremely excited to jump on, guys. Been a little bit of time here, so can't wait to jump on Talk Shop, see if we could add value along the way.
Yeah. Brian, parking lots. Why parking lots? It seems so boring.
Why not parking lots, man? Of course, boring is good. Boring is beautiful. This is the reason that we love the asset class, right? I mean, in business in general, some of those, there's been a ton of wealth created in a ton of different businesses all over the world, right? And some of the most profitable businesses are the ones you just walk by every day and you'd never know the wiser, right? Think about the businesses like recycling old trash and finding ways to take some of that nonsense that otherwise would have been just completely left and repurpose it in some other way. Very boring, but ultimately extremely profitable. It's not always about driving around all the coolest vehicles, this, that, and the other. Simple, predictable, boring revenue over long periods of time wins every day and twice on Sunday, in my humble opinion. So parking lots, yeah, there's not a heck of a lot going on there. So simply just cash flow over and over and over. So we'll take it, buddy.
So based upon that, what made you decide to start acquiring parking lots? How did you know that you'd be successful in that space?
Well, we didn't just come out of the gate firing at the hip thinking that we were going to go for parking from the get-go. Our background, like my business partner, we've been doing this for now multiple decades. He's been in real estate over 25 years. I've been in now over a decade, and we've been in commercial real estate for over a decade, specifically in the mobile home park sector. So we operated the hedgehog model for a very long time on one niche and got extremely proficient in that one respective asset class. Ended up being mobile home parks, right? Really high quality, long-term macroeconomic tailwinds. And we talked about this previously, but we always try to operate our mobile home parks like a parking lot with that in mind, because we don't like to own the homes themselves. We operate a mobile home park like a cash flowing covered land play where we're just stewards of the land in and of itself. And after doing that for a decade, really refining the business model where every time we bought a new mobile home park, it was, a plug and play. We built a vertically integrated property management company. Every time we buy a deal, it doesn't adversely affect the system, right? It's kind of the machine is rolling. So we felt comfortable looking for an additional vertical that would be complementary to our skill set and that would help our investors, again, further generate cash flow and build legacy wealth for them and their families, and found parking to be a really, really good asset class that fit our investment thesis, fit our model, and had a lot of unique characteristics that were very, very similar to mobile home parks. So dove in headstrong, and we've been doing it for a handful of years now. So that was the pivot. It was enough similarities to mobile home parks to make us be interested in digging a little bit deeper into parking.
Well, and I want us to get into the actual model because I think that will bring the similarities to life for those who are listening. But one of the questions I have is just how many of these parking lots or parking deals have you guys entered into at this point? And also, what do you kind of see as like, is that a growing market for you, or is it just kind of like you've just gotten lucky on those?
Well, from my perspective, look, I'd love to buy more and more and more of them. Everyone that we've bought has been really, really solid. As until we've done 50 deals, 100 deals in that asset class, we've got pretty stringent criteria of ensuring that we buy with the margin of safety. In fact, one of the 5 tenets of our investment strategy is to demand a margin of safety. So when we're going into a deal, we have to ensure that there's a pretty solid margin there. And until we've done 50, we want to give ourselves a little bit of wiggle room. So it's been great in that every deal we have done has worked out much better than anticipated, but it means that we really haven't done as many as we like, just a handful. Total AUM on the deals we've done is about $75 million now, and we're looking to continue to increase that over time. It's still the majority of what we do on a daily basis in the mobile home park sector, but this is an additional vertical that we're obviously extremely excited about, and it's provided some fruits to our labor over time, helped our investors generate more cash flow. So we're continuing to try to find those diamonds in the rough when they pop up.
Well, as we were prepping for this call, we were kind of looking through what you guys have done in the space, and it's pretty impressive up to this point. So I would love to help the person listening understand more from an investor's perspective, right? I think this is maybe one of those ideas that sometimes we bring on guests who the deal could be like, hey, you could go out and figure out how to do this yourself, or you could be an investor in an opportunity. As I've gathered this, like most of these deals you're doing seem to be pretty big deals, right? Like not the kind of thing that you just put together a couple of buddies and you guys go buy one. So would you kind of like break down this into maybe like 3 big nuggets of how you guys consider this whole project of getting into the space? And then maybe we can take each one of those points and go deep enough for the person listening to better understand, as an investor, how do I evaluate this as an opportunity for me?
Fair enough. I mean, I would start with maybe, ways to buy, how we find deals, right? Our core competency over time has been going off market direct to owner to acquire deals in a non-competitive environment. As I'd mentioned, my business partner, Kevin Buff, he's one of the old G's in podcasting, right? Real estate investing for cash flow. And the reason that, he got involved and started the podcast is because he was trying to share the insights that he's learned along the way. He built a really large single-family residential portfolio by the time he was in his mid-20s of about 125 single-family homes during the Great Recession, got crushed, and then pivoted to commercial real estate, ultimately found mobile home parks, built him back, set himself back up, and then focuses on real estate investing for cash flow to ensure that you just have sufficient cash flow to ride out any of those recessions. I say all that to inform you that how do you buy 125 single-family homes? Off-market direct to owner, literally hundreds of thousands of pieces of direct mail, tens of thousands of cold calls, all the sorts of things that you're doing to try to drive deal flow off-market direct to owner. And that's one of the ways that we can acquire deals in mobile home parks and parking. We're trying to target fragmented asset classes, right? I literally don't know another human being in this country that's doing what we're doing in the parking sector. We felt like we were ahead of the game in mobile home parks a decade ago when we started doing that. Bringing kind of that skill set over to mobile home parks. And now that we've brought it over here to parking, there's just, not a lot of folks kind of seeing that opportunity and implementing that to try to find deals from those more mom and pop style owners. And that's what you see because it's such a fragmented asset class. By way of example, one of the deals that we did in terms of the scale, right? Joey asked about, the size and the scale of the deals. They range, right? They range. Biggest parking deal we've done is $34 million. Smallest deal we did, $700,000, right? So they range. But by way of example, sent out a piece of direct mail to a doctor in North Carolina, mom and pop owner, who was just trying to generate some passive income, right? Passive income on a monthly basis, greater than monthly expenses, right? PI greater than ME, as you guys know. Yeah, high five and handshakes, baby. That's the good stuff. That's what he's trying to do for his family. But he wasn't necessarily a professional real estate investor per se, right? He's a doctor that's looking to try to generate some ancillary income along the way. And we just reached out to him proactively, said, hey, we like your parcel of land. Would love to, offer you make you an offer on the deal and see if it would make sense from your perspective. Long story short, he was willing to engage in that conversation, which was great. So what we decided to do immediately was go to a bunch of different folks in the vicinity and engage how much they would be willing to pay us, right? So parking operators, how much they would be willing to pay us to become our tenant and actually manage that parking lot on an ongoing basis. This strategy, as opposed to how the doctor had been managing that parking lot basically himself. He was self-operating and self-managing that parking lot, where literally his son would go out there in the old, with a lawn chair and an umbrella and just kind of take cash on an ongoing basis. And whenever you see that sort of, cash style, heavy cash business, there's typically some slippage and a little bit of inefficiency along the way. And when we see that, we know that there's likely ability to operate that a little more efficiently. So when he tells us he's only making $30,000 a year, we know that when we go to parking lot operators in the vicinity and they're willing to pay us a lease of a certain dollar amount on an annual basis after getting a bunch of requests for proposals, on how much they would be willing to pay us on an ongoing basis. We ended up negotiating a $72,000 double net lease over a 10-year horizon for that asset. So as you can imagine, the doctor had only been earning $30,000 per year. We know that we have the opportunity to earn $72,000 per year. And then in advance of negotiating the deal, we can go back and say, hey, well, because we know we're going to have about a $70,000 NOI, we're willing to pay you $695,000 for that deal. Seller feels good because he's basically selling the deal, at a 5 cap-ish. And we're feeling great because we know we're going into the deal immediately at a 10 cap, unlevered, which is a beautiful thing, and if we could just replicate that ad nauseum, year over year, we'd be more than happy to do so, right? It's a 10-year lease with CPI inflation escalators, and it's something that, there's not a heck of a lot going on inside of that parking lot. Just the cash flow comes in every single month like clockwork, and somebody else is there dealing with the maintenance on an ongoing basis. So anyway, that's an example of how we buy deals. That's just one example.
I'm going to take what you just said, because you said a mouthful, and I'm going to slow it down because Joey's eyes are rolling in the back of his head. There's a lot of terms there. So let's break it down for the Joeys listening. So you talked about how you bought the deal. You talked about how you sent out direct mailer to an individual mom and pop owner. So that's good to know that there are mom and pop owners in this space, as well as big, huge, probably property owners that we will talk about. Second thing, you talked about figuring out what the competition in the market is, because the competition is going to dictate what the price available is to be earning money, right? So you go out to the market and you try to figure out what that is. And we do that in a lot of different spaces, right? We're going to go out and figure out all these different ways that we can make revenue, but also we got to figure out what our competition is. What is going to be the differentiator for us? And third, really, you got into a unique thing. You skipped through this, but I know we had a conversation about this prior to press and record. And this is really, I believe, the genius of what you guys have done, is that you've figured out a way to get guaranteed revenue, a way to know that every deal you get into is going to be profitable before you even sign on the dotted line. And for any deal, Tribe, that you're doing, that you can already guarantee the revenue beforehand, that's how you have what you said, one of the 5 tenets of safety, or 5 tenets of every deal you do is this margin of safety, is what the profit margin is. So I'm going to slow that down. I want you to break those things down, and maybe let's go through some examples, because you've done a number of deals. I think maybe each one of those we could kind of like take apart and better understand. So you've just talked about ways that you found and bought a deal. You did this direct mailer. But also, you've done some different deals that were outside of that. Would you maybe take one of those properties, maybe go through how you bought it, talk about the competition that existed in the market space, and ways that you were able to use this guaranteed model for those specific things? So each one of them we can slow down and be able to see maybe from a broader perspective as we're considering this as a potential opportunity for us to invest in.
Sure. So by way of example, I will use the North Beach Parking Plaza here in Clearwater Beach. Gotta love it. Best beaches in the world. Clearwater Beach has literally on multiple occasions been voted the #1 beach in the country by Dr. Beach and some other publications out there. We just happen to be right here. We're in Tampa. Office has been in Clearwater. It is a unique transaction. And if you look at our VTO, using the acronym and terminology and business nonsense here, our vision traction organizer inside of our business, one of the pieces of the puzzle that we lean into is solving complex real estate problems. We try to solve complex real estate problems because if we could do that, we can make a lot of money for everybody involved. And this was such an example. This was a public-private partnership known as a PPP. On Clearwater Beach, there has been a problem with parking for many, many years, multiple decades, where the demand for the product, parking, is through the roof, insatiable demand for the product, and there's just no supply. There's no parking spaces. There's literally one way in and one way out of Clearwater Beach, and over 1 million cars go over it every single year, and there's just nowhere for anybody to park during peak season. So the city knows that there's a problem. They need to develop more parking spaces, and a developer went to them and was like, hey, I'm willing to develop a parking facility. Now it's North Beach Parking Plaza. But he's like, I'm not going to do it on my own. I need you to kind of subsidize some of that, pay for some of it, and be in the middle here. So they created a public-private partnership. That facility was constructed and opened in 2017. So, relatively new construction. After a few years of partnering with the city, they're managing it accordingly. The developer got uneasy. He got a little frustrated with how it was being managed because the city, they're not operating that facility like a business. Rather,
the city is not operating the business efficiently? Wait a second.
I've never heard such. I've never heard such.
Shocker.
I agree. Total shocker. And because the city, they're not making money exclusively off of the parking income that's generated from that garage. They're actually making money from sales tax. All they care about is bringing people down to Clearwater Beach because it brings tourism, economic vibrancy. They make money on, residents staying in hotels. They make some hotel tax income. They make sales tax income. But the developer's like, I don't get any of that. I just want you to raise the parking income so that we can actually operate this efficiently because the demand for the product's through the roof. And the city was unwilling to do that. So he got frustrated. And we were like, you know what? This is an opportunity. We'll look to try to solve this complex real estate problem and net be positive for everybody involved. So we went to the developer and we said, hey, we'll buy out your position. We negotiated that for roughly $20 million. And then we went to the city and they were also in a little bit of a precarious situation because the way that their joint venture style structure was created was that the city was responsible for the vast majority of capital expenditures inside of this facility. And it meant that they really had a raw deal. So in the near term, they weren't really frustrated, but in the very long term, they were going to get crushed inside of this deal. The developer was a little bit greedy. He just wanted more and more and more. But so we had a pain point on both sides of the table. We were able to negotiate the developer's transaction for about $20 million. We went back to the city, negotiated that for roughly $14 million. All in, we're in at about $34 million. That's kind of what we feel the purchase price is going to be. So knowing that information, we go to the immediate vicinity, again, in advance of closing the deal, and we reach out to a lot of parking operators in the vicinity, and they will bid for the privilege of becoming the leaseholder or the tenant inside of our garage. They're a parking management company where they come, they do all the work, they do all the management, and it's a triple net style lease from our perspective. And they bid for the right to become the tenant in that facility. And after vetting a lot of different folks, we were able to negotiate a triple net lease over a 10-year horizon for $2 million a year. And when you take into account the additional retail revenue, it's a mixed-use property. North Beach Parking Plaza has a couple of retail units. The cumulative NOI is roughly $2.5 million, triple net, with CPI increases of 5% year over year for the next decade. And with that knowledge, we now know that we're able to go in immediately at acquisition. So when we closed that deal, immediately at acquisition, that lease went into place. So we're all in for $34 million. And immediately upon closing that deal, we went and got an appraisal on the asset after bringing that public-private partnership fully private and began to charge market rates immediately. The deal was worth $48.7 million from the appraiser's perspective. And we did that in advance of closing the deal, right? So none of the money was at risk until we actually closed the deal. And we were able to create all that margin of safety, right? Demand a margin of safety immediately at acquisition and have this kind of guaranteed revenue over the course of a 10-year horizon on a triple net lease. It's just a phenomenal deal that's throwing off an exorbitant amount of cash flow with a 300 basis point spread between the yield on cost of the deal and the interest rate that we have. It's just, I wish every deal was like that, right? Every single deal. Hopefully we can do more and more and more that are just like that. But it's a complicated transaction, and you can make a lot of money by solving complicated real estate problems.
If you've listened to our show for any length of time, you've heard us talk about infinite banking and how we are able to use that concept to create over $50,000 a month in passive income. But it's just not that easy to figure out, how does this all connect into my own personal system?
Stallion, that's why we created the passive income operating system, bro. It shows you how to turn active income into passive income. It makes all the steps come together. If you would like to get access to it as a podcast listener, we've never given this away in public before, go to what'swhatwallstreet.com/PIOS. There was nothing worse than walking into class when you're in school and the teacher saying, pop quiz day. Why? Because you were unprepared. Are you unprepared though for financial freedom?
Don't be. Find out how close you are by taking our 30-second quiz at wealthwithoutwallstreet.com/quiz.
Well, and the thing that you left out earlier when you talked about this being your competitive advantage, or you called it the VTO, I think is what you called it. And the thing you left out is that your competition is virtually nil. Like the people that can operate at that level of complexity are very, very few. So you're putting yourself in the best possible position to shine. Now, one of the things that you just mentioned about the appraisal has me thinking back to my mortgage days, right? And thinking, well, how do banks even look at these sort of deals? Like, are you able to pay cash for everything, or can you finance them? Like, how did you actually go about that? And can you exit with a refinance? Like, those are some of my general questions.
I want you to answer that, Brian. But here's the thing that I maybe everyone out there is getting this, but what I continue to catch when you speak about this that gets me so excited about finding opportunities similar to this is that what you said is that too often times we get broad opportunities and we have to figure out how to operate the business. And we know that the operator ultimately is going to make a deal or break a deal. And we get a potential opportunity, but then if there's an operation that has to happen on it,
then that could even make a great deal go bad or a great deal become better. And what you said is that you guys didn't go try to figure out how to become parking lot guys. You were not saying, okay, we're going to create our own kiosk that we've never done before. We're going to put in, little those little coin collectors all over the place. We're not going to have guys out there with spinning signs. We're not going to have somebody out there with the umbrella taking $5 and hoping that he's not skimming from us every single time that he has. No, you do none of that. You're like, we're going to buy a space and immediately bring in guaranteed revenue, and we're going to give someone else who runs that business that deal. Like, there's the genius in this. And I don't, that part just cannot be missed in this. And if you can find this tribe in anything that you do, there's a home run. Okay, now go back to as far as how you guys are buying it, how you're financing it. Are you having to bring all the cash? Are you being able to find banks? All of what Joey said. I just don't want that point to be missed because I think that's just so brilliant.
No, I love that. And muchos gracias. I share the sentiment, man. If we have seen further than others, it's only because we've stood on the shoulders of giants. We're not reinventing the wheel here. Other people are helping us along the way, right? We've seen some other folks generate some really high quality triple net leases in various other businesses. But this is something that we were able to bring to a unique industry that we really haven't seen anybody else do. And it's provided some pretty good returns for our partners along the way. So to lean into the guaranteed leases, anytime you start throwing around guaranteed, it's kind of a finicky thing in the crazy world of investments. But this is an example of, like, we have a 10-year triple net guaranteed lease over that horizon. And when we say guaranteed, what do we mean? Meaning we had the parking management company, it's a nationwide company, guarantee with a corporate guarantee, all of the different corporate locations guarantee the profitability of our one location. And we had the owner sign a personal guarantee. So if he does not sign, if they don't come and pay that lease on an annual basis, not only can we sue his entire company, but we can also sue him personally if ever it came to that, right? And that's about as good as an ironclad guarantee as you can get. The guarantee is only as good as the guy that wrote the guarantee. But nevertheless, that's about as far as you could possibly go to ensure in advance that the revenue is definitely going to come in at the end of the day. And then digging into kind of the financing for Joey's perspective. So yes, great question. We operate a very long-term horizon. There's risk in any sort of business investment that you ever make, right? It's just part and parcel of investing in general. But what we always try to ensure we do is, for every dollar that we invest, we want to generate an outsized amount of return back to us, right? So we're trying to create the best risk-adjusted returns, outsized risk-adjusted returns. And in order to do this, we try to stomp out as much of the risk as we possibly can. We do so by putting prudent debt on properties. We'll walk through that in just a bit. But also time. Time is another function of risk that we can't control, right? There's certain things that we can control and certain things that we cannot control. Timing is one of those risks that we cannot control. So we try to minimize the impact of time as a risk by trying to get long-term fixed rate leases over long periods of time. It's an unfortunate truth that there's some sponsors out there that, we're operating with short-term bridge debt over a course of a couple of years. And now we're seeing some difficulties in the marketplace. And we've always taken the position, again, largely based on Kevin's historical background of, being to the top, getting absolutely crushed during the recession, making it back to the top again, and basically saying, been there, done that, got the t-shirt. I'm never doing that again. I'm just going to have long-term fixed rate debt to ensure that we have cash flow to ride out any inevitable recessions that arise. So we operate a long-term buy, improve, refinance, and hold model where we try to get the investors' chips off the table as quickly as we can. And then from that point, we operate on an infinite cash-on-cash return model. That's the goal. Happy to go into kind of how we've done that in various funds historically. But suffice it to say, in the deals that we acquire, every deal is unique. We look at it individually to gauge the type of debt that we should have on that acquisition immediately upon closing the deal. By way of example, the deal that I was talking about in North Carolina, it was a small asset, right? $700,000. And after a year of owning that deal, we'd increase the value of the deal from $700,000 to $1 million in the marketplace by going and getting an appraisal. It appraised for over $1 million. We didn't put any debt on it. We bought it all cash. At that point, now that it's $1 million, we had the luxury of going back to the bank and putting on a first round of financing, basically taking all the cash out of the deal, sending it back to investors in a non-taxable event, and now it's just ripping off ridiculous cash flow ongoing. And that's the model. That's what we seek to do. By way of example, the other deal, the North Beach Parking Plaza deal that we just referenced, you could put a lot of different type of financing on the parking assets immediately at acquisition. And it ranges kind of from the largest and highest, most sophisticated debt that you would put on these assets is life company debt immediately at acquisition. Then it kind of goes down. There's no agency debt because we're not subsidizing housing. There's no Fannie Mae or Freddie Mac debt, but you go to CMBS debt. That's another option. Beyond that, you go to national banks and then regional banks. And those are kind of the options that you would have available to you. In this example, we went to a local regional bank, somebody that actually knows us very well down here in the Tampa Bay area. We've got a track record. We've done deals over a decade. We've built a pretty good relationship with them over time. So they're very flexible with us. Plus, the asset's kind of in their backyard. It's a little regional bank that's kind of down here in the vicinity. And we were able to negotiate at the outset a $20 million loans, roughly a $20 million loan at about a 4% interest rate, which gives us about a 300 basis point spread between the yield on cost and the interest rate to allow us to throw off cash. And if you run math on that, whatever, $20 million on a $34 million loan, we're typically 60% LTV, something like that. We never like to get out in front of our skis from a debt perspective. On any given individual deal, we might go up to 70% debt. Or if it's like a ridiculous off-market deal where we can negotiate ridiculously phenomenal seller financing, we might go up to 75% if we can get like ridiculous seller financing terms that you wouldn't otherwise be able to get. But generally speaking, we're going to end up getting maybe 60%, 65% LTV on any given individual deal. The amortization period for a parking facility or parking lot is typically going to be 25 years, somewhere between 20 and 30, but typically 25 years. And the term that you're able to negotiate is typically about 10 years. We like to get 10 years. Sometimes the bank will only give you 7. Sometimes the bank will only give you 5. But we like to try to get it as long as we can. And then what we really like to do is negotiate down the prepayment penalty. So basically maybe like a 210 step down prepay. Because what that does is it allows us to have our cake and eat it too. Where if we know that we have a long-term 10-year term, we can ride out any of the next inevitable recessions that happen over the next 10 years, which is great. We can cash flow through it if we need to. Or if we're in a really high quality bull market where prices are going wonky and, they skyrocket to the moon and life is good and everybody's doing well, the step down 210 step down prepay means that if we sold or ended up doing a refinance in the first year and replaced that debt, we'd have a 2% penalty. If we did that same exact thing in the second year, there would be a 1% penalty. But starting in year 3, there's a 0% penalty. There's no penalty for doing a cash out refinance or changing the debt on the asset. And it gives us a ton of flexibility from year 3 to 10 to basically just sit around and watch Jay Powell eating popcorn, wondering when he's going to lower the rates, and then just do cash out refinances when market conditions warrant, instead of like having forced liquidity events and, people's, backs against the wall. They got to do a fire sale because their debt's coming due, that sort of stuff.
Well, that helps me understand like what the opportunity is, because I imagine the 10-year lease is what really helps a bank feel comfortable about that deal. I mean, the way you've structured that, like you said, is as ironclad as you can possibly do it. The bank's always concerned about risk and longevity and so on and so forth. So you've really taken that off the table for them. I love this. Now, what percentage would you say of these parking assets that you run across are owned free and clear or open to some sort of owner financing? Is it majority, minority? Where do you stand on that?
I would say probably minority seller financing. There's a lot of things that go into whether or not you're going to be able to negotiate that. That's really about being in a phone booth, right? As a buyer, my business partner's had thousands of these conversations off market, direct to owner. And if we can get him in a phone booth with the seller, oftentimes we feel pretty good. If there's a bid-ask disparity where Kevin comes out on that, pretty well, where we feel good about the terms that we're able to negotiate in those transactions. But really that's about discovery, uncovering pain points, finding out what his pain points are as a human being and trying to solve those pain points for him. Whether he needs, he's trying to retire and he needs income for him and his family, or whether he doesn't want to pay capital gains tax for whatever reason. And because those problems are so idiosyncratic, it's a minority compared to the majority of deals that come across the desk. But when it does happen, it's phenomenal. I won't go off the rails. We can give you examples of that.
No, that's Joey's creative brain, always thinking, how can I buy something seller finance? And I keep having to remind him, I think
my favorite.
This is not a deal. This is not a deal for probably the average person to get involved in. So I don't think this is a conversation we need to have. But as we wrap this up, right, because I'm an investor listening to this, and the question I try to ask as many people is there, if we're talking about a specific deal, right? Sometimes we're just talking about ideas and strategies and how someone became financially free. But whenever we get into deal-specific conversations on the podcast, I like to ask this question to every single person. I know you've been asked this before from investors. How do I lose all my money?
How do I lose all my money? That's a great question. As I mentioned at the very outset, we try to remove all of the risk that we possibly can. It's impossible to remove risk. Like we said, whenever anybody makes an investment, there's some sort of level of risk. And we just try to mitigate that risk to the best of our ability. I'm trying to think of how could I lose all of my money?
Like, could someone,
the way that I would,
you bought one of these assets, could the city come in and like change zoning on you in the midstream? Or like, is there something like that would be like a black swan event that would totally affect the business?
More than anything else, from my perspective, it really would come down to debt as the biggest variable that would be the largest risk for an investor. Because if you're making imprudent decisions and you're getting what I consider to be over leveraged and out in front of your skis from a debt perspective, oftentimes or periodically sponsors will try to use financial engineering to make the numbers work. Where, yeah, the cash on cash return is X, but if we just go, rank up the debt to 90%, well, then the cash on cash return can be a little higher. But debt cuts both ways. And if the market goes down, in an example where you own $1 million property and you put 90% debt on that property and the market goes down 10%, well, then your equity is wiped out in its entirety, right? Whether you've actually sold the deal or not. When that debt comes due and the term comes due, that's a precarious situation. So it's just about trying to ensure that you maintain the margin of safety throughout the entirety of the holding period. That's the biggest one that I would lean into in terms of losing all of your money. We view these as cash flowing covered land plays, long-term cash flowing covered land plays. And when you're buying land, real estate's all about location, right? And if somebody is willing to pay you just for the right to stand on the parcel of land that you own, then you have a very valuable piece of land, and it is very likely in a very high traffic tourist destination or a really high quality downtown urban CBD. And that location is very likely to be in high demand, not only today, but in 5 years and 10 years and 20 years and 30 years and 50 years. And real estate over very long periods of time has historically performed very well, right? The first millionaire that's ever been in this country was John Jacob Astor, because he bought some stuff on the island of Manhattan hundreds of years ago. And can you imagine if he never sold it? Holy shnikes, we'd all be doing a heck of a lot better, right? So it's just about buying great pieces of land and holding onto them over very long periods of time and putting very prudent debt on those assets to allow the long-term macroeconomic tailwinds to do their thing and just let real estate do its thing.
Dude, that's good. By the way, I know I threw you on the spot there, and thank you for answering that question. It does a couple of things for us as investors. Travis, you were listening to Brian. He's having to think of all the ways that deal could potentially go bad. What a great question to ask every sponsor, every operator that you're investing with, because it's going to you're going to learn something in that response is going to help you not only with that deal, but with other deals. You just gave us insight to how we can evaluate other deals in the future when there's that margin of safety, as you talked about, could go away if the debt continued to increase and the equity then was reduced by that. Like there's brilliance in that. Thank you so much for going through that process for us, because we learn and become better investors. And that's the whole purpose of the podcast, is that we will become better investors so that then we can make better decisions that help to build more passive income than we have monthly expenses. Now someone has heard this. If somebody wanted to connect with you, where would you tell them to go?
Couple things I'd say, yeah. If you want to learn more about parking, Joey and the team, thank you very much. You got a wizard in the back office there putting parkinglotprofits.com down there. It's a beautiful thing. But yeah, that's what it is, parkinglotprofits.com. It's a little free ebook you guys can download to learn more. It's called the Passive Investing Guide to Parking Lot Profits. Learn a little bit more about why we love the asset class so much, kind of the top 10 reasons and so much more about why we think the asset class is so phenomenal. And I would say, if you want to learn more about our team, our fund, what we do, how we try to help our investors, you can go to investwithsunrise.com. That's where we lead folks who want to learn more about Sunrise Capital Investors. That's our actual investment firm that helps people do what we do, right? Try to help as many people as possible, generate cash flow, build legacy wealth in a tax-efficient manner. All the deals we talked about today are deals that limited partners own in one of our funds. So that's where we point folks if they want to learn more.
Well, Brian, it has been such a pleasure to have you. Thank you for being willing to come on and share with us today, and how you're building legacy wealth for your family and then sharing that with others.
It's a beautiful thing. Well, thank you guys for the exorbitant amount of educational material that you put out. I can't tell you how phenomenal that is, and how much you guys are doing to benefit thousands and thousands and thousands of people all over the country. It's a beautiful thing. It was a pleasure to guys have you on the Legacy Wealth Summit, and keep doing what you're doing. It's absolutely beautiful. Thanks for having me on, and hopefully we added a little bit of value along the way.
Absolutely. Tribe, if you got value out of this today, please let us know. Take a screenshot of this, share it on social, tag us. Let us know this is the kind of stuff that you're wanting to learn more about so that you can also build legacy wealth for you and your family as you gain financial freedom. As always, have an amazing day.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand so that your wealth will never run dry. See you next episode.